would like to introduce Todd Barney, and for those of you who don't know him, because he has spoken before, and he's also worked with us in providing some really excellent speakers, economists, portfolio managers, for other presentations that we've done. Very knowledgeable. He works with Invesco and is responsible for probably the entire West Coast, and I think he's ready to be owner of Invesco, right? He's a step away. So please feel free while Todd is up here, if you have burning questions, please feel free to jump in and ask them. If the questions can wait until the end, that would also be good. You've got books in front of you and pens if you'd like to take some notes. And we are also providing you the LPL Outlook, which may have some of the same topics that Todd will cover today. Let's get started. Todd, welcome.
Thank you. Thanks, Kevin. Always good to see you. Thank you. Well, thank you, folks. This is a pleasure and an honor to be here. I was telling Kevin as we were trying to go over how many years we've been knowing each other and working together. It's a sad, sad exercise, isn't it? As my 11-year-old says, Dad, you're no longer salt and pepper, you're just salt. So that's what's been happening in my world through COVID. To Kevin's point, we have gone through an awful lot in the first 6 months of this year. I don't want to belabor the point, but I always think before we start talking about the future or the way that we're envisioning what's going to happen going forward, we should revisit briefly where we are. Before jumping in there, again, as Kevin said, my name is Todd Barney, and I have the pleasure of representing Invesco for Northern California. Actually, specifically just Silicon Valley, and as Adam and I were just talking in the back, the state of Hawaii is also mine professionally. So, tough crowd already. So, no, I'm very, very fortunate and very, very happy to be here. The three areas I thought we would focus on, and they should be pretty encompassing, are going to be hitting on the inflation topic head on. Let's address that first and foremost, because I think that's where, and I'm confident we're all feeling that the most, even though we're having a bit of relief at the pumps in terms of gas prices. So I thought we would address that and its impact on both the US and the global economy. Then we can transition over and talk about, unfortunately, what's happening with Russia and Ukraine. The geopolitical risks that we're facing this year are absolutely atrocious, and the human count is absolutely the worst. But we need to also look under our framework at how to navigate that challenging environment also. And then finally, I thought I'd wrap up with the US election, because what way to make better friends than to talk religion and politics? So that sound okay for everybody? Perfect. And as Kevin said, please ask me any questions. I'm happy to go through. If we don't have the answer tonight, we will get them for you, but I'm pretty confident that we've surfaced several questions, and the amount of research we've done is going to be a pretty solid conversation tonight. So let's hit inflation. It's arguably the most impactful that we've seen. It's all over the headlines. Regardless of your political affiliation, I know there's been some jokes blaming either side of the aisle. I will tell you, I'm not going to blame either side of the aisle. We're going to talk about the fact that economically, this is exactly where we should be. And I know that seems strange, but this is exactly what the issue was coming all the way out of 2008's financial crisis. At that time, and I don't want to take anybody that far back in history, but the point was, after the housing crisis and the issue that blew up from the global financial challenges we were having, the central banks around the world worked together to stoke inflation. They wanted to get the economies growing again, to get us to grow our way out of that, and that was the positive side. In fact, the only shortcoming that happened worldwide, whether you were here in the United States with the Federal Reserve, whether you were in Europe with the European Central Bank, whether you were in England at the Bank of England, or even in the Bank of Japan, the only thing they could not do is create inflation for 15 years. They got employment down. They kept prices stable. Many of us were laughing when we were refinancing. I was talking over here about mortgage rates, and we were excited of those rates that we'd locked in for 30 years. At the same time we were toasting each other on our mortgage rates, we were complaining about how bad the savings rates were. That was exactly what we were trying to stoke, that growth, that innovation, all the investment that we experienced over the last 15 years. Global pandemic hits, the economy stops on a dime. We reopen, and we reopened before labor was ready to be there, and you had inflationary pressures building, and building very, very quickly. It's up to debate if the Fed made a mistake, and Jerome Powell and the president of the Fed governors, when they were making their voting policy in terms of interest rates, did they wait too long? The quote you may have heard on the news, are they behind the curve? That was the big piece that was there. All it means is, did they wait too long to tap the brakes on the economy to slow it down? In our opinion, the answer is no. The economy was in such challenging straits, the Federal Reserve and other central banks wanted to ensure that the momentum of the economy was strong enough to keep everything moving forward, to allow all of us to have that growth and innovation and to continue. Now we fast forward, and you may have heard the term transitory. That was what the Fed was famous for. Inflation's high, but it's transitory. We're reopening, this will come back. The unfortunate piece was we then had what happened with Russia and Ukraine and a couple of other the geopolitical pieces. I was talking to a few others that were at airports over this past week like I was. Flight cancellations, help wanted signs, folks not coming back to work. You're seeing these challenges of a reopening economy with all of us in this room and everybody we know with this insatiable demand. Let's get back out and see people and connect and be in person. Unfortunately, the infrastructure wasn't ready for all of us to come back rip-roaring as we have. And I'll tell you, I just got back from Hawaii, and it was partially vacation and partially work. Please don't roll your eyes. It really was work for a few days. It was amazing to see that they were having the exact same issues. The other scary part to me, gas in Hawaii was cheaper than gas in California, but that's neither here nor there. Point being, the economy is back, it's rip-roaring, and now we're feeling the challenges of this inflation that's been exacerbated. So the question I get is, how much longer is this going to continue? And I submit to you, in our opinion at Invesco, that inflation is peaking as we speak. Now, unfortunately, in economics, as we all know with the passage of time, there's not any true linear function. It's not like inflation hits a number and then drops straight down. It's that jagged bump, and certain areas have the more alleviation than others, and that's exactly what we're seeing. As we see these pressures subside, you will see the Federal Reserve start to pull back on tapping the brakes on the economy. That soft landing that you're hearing so much about. That's what they're aiming for. My wife loves gymnastics. They're trying to stick that landing like Simone Biles. We'll see if Jay Powell is as athletic as Simone Biles is, but that's what they're trying to navigate right now. The second question when it comes to inflation and Fed interest rates is it going to be 50 basis points or 0.5%? Is that what they're going to do? Is it going to be 75 basis points or 0.75%? Is it 1 full percent? I submit to you, the number is irrelevant. And I know that seems a little bit counterintuitive, but the reason the number is irrelevant is the Federal Reserve is doing what they're supposed to. They're slowing the economy. They're trying to slow the demand from all of us to pull back on that increased demand while the supply catches up. The reason that the number is irrelevant is we pay more attention to the press conferences and the commentary from the Federal Reserve after the fact. And they are softening that language already. There's an index called the Financial Conditions Index, and I won't belabor why, and for those of you that care, I'll be happy to stick around and talk to you about all the components that go in, but just count on the fact that from an anecdotal standpoint that it's short-term interest rates, it's auto loans, it's credit cards, it's mortgages, and what you've seen is that those financial conditions, the ease that all of us can borrow money, have become very, very tight very quickly. They actually peaked in November of last year and have continued to be more restrictive. The Federal Reserve knows this, which is why they've already been softening, saying we can be more data dependent. If the numbers start to get better, we can slow down on our increases. They're preparing all of us for what they're intentionally doing, and that is slowing the economy. I'm a big music fan. I know a few of you have seen me in the past, and I talk about it quite a bit. And I'll try not to belabor music too badly, but one of my favorite musicians, Tom Petty, had an album called Damn the Torpedoes. I see a couple of people nodding their heads. There's some Tom Petty fans. For history folks in the area, and I'm also a history major, it actually goes back to the Civil War. And there was a a Navy admiral that was trying to raid one of the ports. And he was famous for saying, "Damn the torpedoes, full steam ahead." In the investing world, this is not the time to say, "Damn the torpedoes and full steam ahead." We want to be thoughtful and cautious and pay attention to the information that's coming towards us, because that is what is exactly taking place from multiple sources trying to prepare us for a slowing economy intentionally to pull the demand down so that supply can catch up and we can be in a much more healthy glide path going forward. So the takeaway there for inflation in the United States is that we believe the U.S. is going to continue to slow down through the rest of this year. Don't be shocked, don't be afraid, and don't be scared. Most of the time when I hear, are we in a recession, the real question behind there is, am I going to lose money? Right? All right, I'm hitting a few folks. That's great. When we look back over the last 10 years, we've had 3 negative years. I said 4. We had 3 negative years on the S&P 500, 2011, 2015, and 2018. We did not have a recession in any of those years. Recession doesn't mean that we're going to have negative stock market performance, and you're seeing that come back as the world has settled into this current environment, just like everybody else, and that's why I brought in how hard the first 6 months were, when we're adjusting to the new normal, when we're adjusting to the current conditions versus those that we were so comfortable with for the previous 14 years under no inflation, it feels painful, it's challenging, but it is not the end of the world. And that's what the Federal Reserve is working so intently on. The other challenge that we have is what's going on around the world. The U.S. is leading the charge. We were first to come in and to throw everything we could in, including the kitchen sink, to save the economy. The rest of the world followed suit. Our concern is, and we're watching very closely what's happening in Europe, specifically when I get to Russia and Ukraine, with the challenge they're going to have with energy specifically, and how that could impact going into the winter months, but also what's happening in China. And China is an interesting one. I don't know, did anybody see what China's central bank did this week? They actually cut interest rates. The flip side of the coin from the United States. We are trying to slow our economy. China is trying to stimulate it with everything they have. They cut interest rates because of their zero COVID policy, frankly, and the reopening piece. So for everything that we're worried about from inflation, that's why we have a diversified portfolio when we look around the world for investments. At certain times, the U.S. may be at the height, and that's going to be the right spot. At other times, it might be worthwhile to look outside of U.S. borders, and that's the type of environment, and again, the information that we want to focus on. Let's move over to Russia and Ukraine, because that's going to impact a lot of that inflation talk and that central bank policy as well. As I said, the humanitarian crisis is absolutely second to none. It's atrocious to watch. Anybody that knows after this, I'm happy to tell you, but there was a 60 Minutes expose that caught my attention, and the reason is my wife and I said we're a family of three, we have an 11-year-old son. They interviewed a family that had an 11-year-old son. I mean, it was just shocking to see. That being said, what was the most interesting piece was they were talking to the folks about how they were building bomb shelters in Ukraine, and they are using food export bags to build bomb shelters. And that, your reaction, Miss, is exactly what I looked at, and I latched onto it. And the reason I did, I don't think anybody in this room, and if there is somebody that did know beforehand, how important Ukraine is to the global food supply, it is nothing short of shocking, and it sets into motion why we believe Putin decided to do what he did with Ukraine. He was able to destabilize the entire global economy in one terrible, horrific act. And that's what we're navigating now. So we're talking about inflation from a fundamental standpoint where we're able to mathematically understand we've been here before and how we can work through those areas. Within the framework concept, now we're trying to, for lack of a better word, handicap crazy. And I don't want to sound insulting, but that's exactly what it is. So what we've been looking towards are the impact that this could potentially have. I talked about the impact in Europe already. Our number one concern is energy supply coming into Europe. They are so beholden to Russian natural gas and energy that we have to find another way to get there. The good news is the United States is actually being able to export liquid natural gas. We're absolutely putting a full charge there, and it's been an absolutely spectacular place to see growth, and one of the positive areas in the U.S. economy this year. It's been up just exponentially, and we believe it will continue to be so, and do so. To give you an idea of how big the impact was on the energy piece and commodities overall due to the geopolitical risks, we look back at the calendar year of 2021, so January 1, 2021 through June 30th of this year, so 18 months, right? Everybody with me? Natural gas prices. Anybody want to take a guess what natural gas is up in that time frame? Somebody take a guess.
300%.
Very close, 266%. Natural gas. My propane guy loves it. No, I'm kidding, that's terrible. Natural gas up 266%. Oil, gasoline, I mean, this is the one we all feel at the pumps. Oil and gasoline up between 150 to 190% in that time frame. You've seen these pressures that we were already experiencing get exacerbated by the uncertainty of what was going to take place. The interesting piece is it also carries through to agriculture. Corn, wheat, sunflower, all up over or between 30 to 95% in that 18-month time frame. This is what we're paying attention to because those input costs are the challenging piece. Target just had a earnings call yesterday. The call before that for the first quarter, the CEO said a couple of the most alarming things we've seen, and thankfully, with 3 months to now look behind and see, he was able to change his tune substantially, and that's most important of what we're talking about from the framework going forward. But at the end of March, he was on the call and he said 3 things that scared us all to death. Number 1, they had inventory in their stores they could not sell. The stuff they had on the shelves, they could not sell. It was big furniture items, clothing, things of that nature. So they were going to have discounts and cut their prices in order to stimulate all of us to buy those goods. The second piece was they couldn't get the inventory they were looking for. That supply chain issues that we had talked about and heard about so much. They couldn't get anything. And I will tell you, we run a supply chain disruption index. All it is a way to measure the supply chain disruption that's taking place. That has been precipitously coming down, and very few people are talking about it. Another reason we believe inflation is peaking now. The supply side is coming down. So supply of goods are coming up, the rates for borrowing are coming down, or excuse me, the rates are going up, so the demand's coming down, and you're getting that equilibrium. He cited that as a very big headwind 4 months ago. The third one was the most concerning to me personally, and it goes back to the cost of gas and oil. He said that they wouldn't send half-full trucks to their stores to restock the shelves at $8 a gallon for diesel. Sensible businessman, but it doesn't make anybody feel very good about what's taking place. Now, just because I want to submit to you and show you what's been taking place, 3 months later, his call yesterday, he actually upped the guidance for store sales. They've been able to get goods to the stores. The discounts have been working in clearing that old inventory, just like we were hoping they would do. And gas prices have come down. Not substantially, but they've come down enough where you're having that pressure relieved. That's what I was talking about the zigzag pattern of having these come down. We're seeing those come to fruition. This is also important because Russia finally came to the table and opened up the grain exports, leaving through the Black Sea, something they were very, very concerned about. You're getting the food to get back out, and you're having a lot more downward pressure on prices there as well. So we're starting to see those alleviate. The issue that we're focused on now is China reopening. That zero COVID policy they're starting to get through, and they're reopening their cities. That's going to be additional demand that's going to pull onto the energy sources that we have worldwide. That's why the Iran nuclear conversation was taking place, and then renegotiation there is so important because that's another 1 million barrels of oil a day coming online that could possibly be there. So there's these green shoots of hope that are very, very exciting and keeping our eyes open, but we're cautiously optimistic when we look there. Finally, when we get to the end of the road, when we talk about the U.S. election, and who would have thought the U.S. election would be the light piece of the conversation? I can tell. Uncomfortable laugh. So that's what we get when we talk politics. I am not here to judge the social aspects. Absolutely not. I was raised to not talk about politics and religion, and here we go violating that. What I will tell you, and I actually talked to my mom. Many of you know that I love my mom to death. I beat her up constantly in presentations like this because she just can't get out of her own way in certain pieces, and she is absolutely panicked about this election coming up. And I will tell you, when we look back to over time, the elections matter so little compared to your investing experiences because the economics are what really drive the investments, not the politics behind it. In fact, when we looked back at midterm elections, not the year of the midterm election, the following 12 months, so 2023 for us in this case, we looked back over the last 60 years, and every midterm election, the following 12 months, was positive for the U.S. stock market. As I told my mom, probability is you will make money regardless of what happens in November. Now, we have to look at some of those headwinds. As I said, I'm not being Pollyanna about it, but that is the big piece. Divided government is actually the best. I was looking through the LPL documentation here. They actually have a slide. I can supply 10 more slides of different pieces where we isolated different political environments and why that was to do better, why you were able to have those total returns. But if politics are what are concerning you in your portfolios, please discount that as much as possible. Having an 11-year-old at home, I watch a lot of Disney Plus. I watch a lot of the Disney Channel. I will tell you, and the best piece that I told my mother today is turn off CNBC and turn on the Disney Channel because every program ends happily ever after. The market is going to do exactly what it's going to do regardless if we watch it every day or not. Whether we're panicked over what's happening with the midterm elections or the presidential election or whatever political influence you want to talk about, that's all going to happen regardless. But having a sensible plan, using the framework of what we believe is going to happen with those pressures of inflation coming down, the slowing demand coming from the consumers around the world, and supply coming back online, will lead to better returns and better experiences than panicking over what happens in the White House or on Pennsylvania Avenue. So with that, why don't I pause and answer some questions? I'm happy to go wherever you would like. So the question was, beginning of the year, there was no place to hide. To paraphrase, it was absolutely true with everything down as much as it was. If we're approaching retirement, we're already in retirement. What can we do? Because I would actually add to that, Sandy, that Inflation hurts even worse when we're on a fixed income. I told you I was beating up on my mom all the time. My dad happened to retire 18 months ago. So now I'm dealing with a retired engineer that's questioning me about everything on top of it as well. So I don't mean to offend any engineers in the room. I love you to death, but the questions that come out are absolutely second to none. To answer your question, higher yields, higher interest rates, and I know this is counterintuitive, but as interest rates move up, the value of your bonds go down. And that's what happened this year. That's why I highlighted that 5-year treasury. And the reason I highlighted that is that's considered the short end of the yield curve. It's a limited maturity. 5 years is rather short. Usually you'll hear when people talk about interest rates, they quote the 10-year treasury or the 30-year treasury. So the 5 years on the very short end. That area of the yield curve from very short term, 0 maturity to 5-year, had the most serious backup in interest rates, the most steep, the highest level of pain that came through. In fact, today, if you look at it, the 5-year treasury is yielding somewhere around 3.30% The 10-year treasury is yielding only 2.9. So twice the time frame till maturity to get my money back, and I'm taking less interest rates for that. That's because the entire world believes that inflation's coming down. That's exactly what that is. We're worried about inflation on and higher rates there. It's a very long-winded answer to get there. The reason I belabor the bond piece is the higher yields buy a lot more leeway, a lot more variance in there for you. So now instead of being paid close to 0%, like I joked about for the previous 15 years, we're now getting paid 3.5%, 4% in interest. That offsets a lot of the challenge. So we would argue that most of the bond pain has already happened, and that's what you're hearing from the Federal Reserve. They're going to be able to slow down on the interest rates. The market participants, all of us as investors, we're not trying to get in front and sell beforehand or buy beforehand. You're getting much more stabilized and more, I hate to use the term normal after what we've gone through, but much more historic averages in terms of the movement. So that's where I would say is to reevaluate your risk spectrum. That's what this latest rally's done, frankly. When you look at the stock market, at one point, the S&P 500 was down over 30%. You had the NASDAQ that was down roughly the same, and people were absolutely panicked. And we were joking about it earlier, about some of those folks that unfortunately sell out at the wrong time. In just the last 6 weeks, you've seen almost 15 percentage points come back on both the S&P and the NASDAQ. It's that volatility that's allowing people to take a pause, reevaluate your risk for your portfolio, and make adjustments as necessary. That's why I use that term framework. I know it's semantics, but that's why it's so important. Thank you for asking. Great question. The question was, we have horrible inflation in the United States. I added the word horrible. She doesn't think it's been that bad, so fair enough. So we've had inflation in the United States. How does that compare to the rest of the world? We are actually in a slightly better spot. The Bank of England came out just this week and said that their inflation rate should peak at 13.5 or 3%, 13.3, almost 13.5%. We're complaining at 9.1 or 8.5, depending on which measure you look towards. And by the way, on a side note, that frustrates me too. I love that the government strips out food and energy. You tell me how you live without eating and driving, and that would be amazing. They are the things, but they are volatile, and that's why they strip them out. But when you look at what's happening in Europe with 13.3%, the other interesting piece that they said is that theirs isn't going to peak until the end of 2023. So the United States, by being as aggressive as we have been, is speeding up that cycle. In fact, part of what we talk about is where we are in the business cycle. When you want to invest, what type of assets do better in given areas of the business cycle? We argue that we are definitely in the slowdown phase. The Fed is intentionally trying to slow us down and get us into that soft landing, I said, with the possibility of a mild recession, but to exacerbate and expedite is the right word, not exacerbate, expedite the recovery. Europe is just simply behind us in that fact, and they're running into the problem that if we start to talk about possibilities of Russia weaponizing energy during the wintertime, if the energy prices climb at the same time as they need to raise interest rates, that is going to be a very challenging environment for a central bank to navigate through. Christine Lagarde is the president of the European Central Bank. She has come out and said that inflation is going to be sporadic because it's not the United States of Europe like we have here. So you have the European Union of these independent countries that are all experiencing their own inflation rates, but borrowing at a single rate, which is something that you may recall from years ago got us into trouble, where you had those in Greece and the southern countries that wanted to retire early and not worry about it, and those in Germany were saying, no, everybody's got to pay their own way. So they're ferreting through those, but you're seeing inflation rates that are quite volatile there as well. That, again, is why energy is so key and what we can do to help mitigate that. Frankly, most European countries are trying to stockpile natural gas at this point, which is why it's so important that the United States can export there as well. And you've seen the United States natural gas prices go up almost 9% in about 8 days now because we're bringing another facility online. So to answer your question, we are still in very high inflation. Ours is trending in the right direction. They're just simply behind us and trying to catch up versus China, as I already talked about, that's cutting interest rates to stimulate growth. They don't have inflation problems at this point right now. Craig, you have a question for us? It's a fair question, and it's one that's been circulating more and more. The question was, did the Fed miss it? And I'm going to paraphrase it, behind the curve again, because that's what they were. They were saying we're going to keep rates down forever. And to your point, they do have the dual mandate. That's it. The true stated mandate is price stability. The only correction I would add there is that they moved about 3 years ago from that 2% target to a range-based. They wanted to be able to have a little bit more latitude because since 2008, they hadn't been able to get inflation as high as they wanted. So they wanted to let it run, quote, and the quote is legitimate, was a little higher than the historic averages. They were okay going to 3 or 3.5% to try to have the average be somewhere in that 2.5 to 2 range. The employment numbers absolutely is right as well. In fact, that's one of the biggest arguments as to why we are not in a recession right now, are the employment numbers that just came out. The exact quote, whether you like them or you don't, came out of CNN, and they said blatantly, you can't say we're in a recession with 500,000 people getting new jobs this month. Seems pretty fair, right? If you're adding that many jobs. To your point about raising interest rates, the challenge that we have is, when's the right time to tap your foot on the brakes or the accelerator for an economy? And out of 2008, when we were coming out of that, and remember, Jerome Powell is simply taking over from Janet Yellen, who took over from Ben Bernanke, who took over from Alan Greenspan, if I'm not mistaken. I'm trying to go through all my folks all the way through. But you have them learning from their predecessors is the key. And the biggest knock that we had in 2008 with Ben Bernanke was he pulled away the punch bowl too early. He didn't keep the accelerator down. So now fast forward to COVID, and the entire world is shut down, and nobody on the planet knows what to do, because the last time we had this was 1918, and we had the only way to look back at it is, how do we stimulate the economy? So immediately, Jerome Powell cuts those interest rates to 0. They pumped in free money to municipalities, state and local municipalities, whether they asked for it or not, which was wonderful because that kept payrolls going. They gave free money to individuals, depending on your income level. All of those pieces were there to save the economy. That was the recovery piece. In fact, that was probably the one bill they actually named the right thing, calling it the Recovery Act, because that's exactly what it was. Put a floor in and stop the bleeding and the pain. Now you fast forward, we go through that downturn, we're through this recovery through 2021, and people start saying, why didn't we raise interest rates sooner? And the argument is, as I was talking about, those financial conditions were tightening earlier than they anticipated. And so Jerome Powell, to your point, was trying to be more transparent. And a quick reminder for folks that it may have been to one of the previous sessions I was at, Jerome Powell is actually the first non-PhD in economics we have at the head of the Fed since Alan Greenspan. No, I take that back. Ben Bernanke was the last. He's the first non-PhD in economics. He's an attorney by trade. The reason I highlight that is he wants to be understood. Think about it. If you're a litigator and you're sitting in front of a jury or a judge, you're trying to convince them of your point. You need to be clearly understood. And when he took the helm of the Federal Reserve, he was almost too transparent. And he said that we were on autopilot was the first one to start raising interest rates, and the market sold off. That's actually, we would argue, part of the reason you had a negative total return in 2018 without a recession. The Fed said blatantly they were on autopilot for rate increases. They weren't paying attention to that data anymore. So he learned from that experience not to do that again. He learned from his predecessor not to pull the punch bowl away in that stimulation to the economy of the lower interest rates and the excess cash. So they kept their foot down a little bit longer than now, with hindsight, and the benefit of hindsight being 2020, than they should have. The one issue that I would take issue with, and that we do, and it concerns us when we look back at what the Fed did, was the idea that it was transitory. Because when you start to see the wages taking off, when you start to see hiring happen, that's where you have it. And the reason we say that is there's two different types of inflation. There's demand pull. That's, I can get credit and I can go out and buy a new Porsche tomorrow because I just want to have a Porsche. And then there's the fact of supply pushing, where the government or whoever it is pushing money out to everybody to spend, and that money needs to find a place to go. That was the issue. Once people get hired and they're able to have higher wages and they have higher incomes, what do we like to do? Spend. And it's a proof point to that is, and if you look back at over the COVID crisis, how many more Amazon trucks do you see in your neighborhood? We couldn't go anywhere. We had all this money. People in this area especially, we were, and I tell folks I'm actually guilty of how well we did surviving through COVID. I was able to transition to pure online, didn't miss a beat in terms of business. I couldn't go anywhere. I couldn't buy anything, or I couldn't do anything fun, but Amazon would sure keep delivering goods to me. And unfortunately, my wife and my son and everybody else, but we have a ton of Amazon trucks. Now then, the economy opens up. And this is why I say you see the flight cancellations, you see the airfares through the roof, you see rental cars. Now we can go places again. And what's the most important thing? To get those family connections back. So that's where it comes in. So yes, Craig, they were late, intentionally late, but the transparency is absolutely there, which goes back to my original comment. I don't care what the actual movement of interest rates are. I care what the content is behind that. What are they saying? What are they trying to do? What are they looking at? What's the message they're conveying behind the actual movement of interest rates? So the question was the zero COVID policy in China, and number one, is it going to work? And number two, is it going to continue to wreak havoc on the global economy? I'll tell you what, I'm going to take the second part of that question first, because I am not a medical professional. So will it work? I cannot speak to. Personal opinion, I don't think so. I think we've tried to find herd immunity here, and we've had the different challenges that we're going through as a country and as the rest of the world outside of China. Wreaking havoc on the global economy, absolutely. It hits everything that we're talking about, the supply side. I mean, it's a big issue. In fact, somebody earlier asked me to talk about Taiwan and China, and I'll tell you, this does not fit into our framework in terms of a likelihood. But what we did discover through COVID is supply chains matter. And we did not know how vulnerable we were until the disruption happened. And China shutting down manufacturing for zero COVID policy negatively impacts that supply that's there. I do laugh about it because I'm kind of nerdy this way, but as I said, we have an index on the supply chain index, and it shows you the mountain chart of how it works. When I was in Honolulu on the vacation portion of my trip, since I have to delineate for this group, when I was on the vacation piece, I was standing on the beach and I saw 4 container ships go by on the horizon, and I could not get my phone fast enough to take a picture. That's exactly what we're talking about. The supply chain is loosening up. It's just not as fast as all of us would like. So yes, that zero policy is going to have some ramifications, or it could. The interesting piece is, and the cutting of interest rates this week shows us that they're realizing their economy is slowing more than they wanted it to, and they're going to be much more accommodative going forward. So I wouldn't be surprised to see a change in that zero policy either. We've seen the political posturing happening between Washington, D.C. and Beijing. We can't hide from it. And there's saber rattling. My portfolio manager, who runs our emerging markets portfolio that invests roughly 30% of his fund in mainland China, actually wrote an open letter to the Chinese government saying business needs each other. This is a global economy, whether you like it or not. That's the fact of the matter. What's been interesting is we've had business leaders talking through our research process, business to business understand that piece, the political implications of the challenge. The interest rates coming down is very good because they're stimulating their local economy. They have an issue with real estate there as well. They're actually having a lot of the folks that had signed on to buy homes stopping paying their mortgages because the construction has stopped. They need to prime the pumps domestically within China to get the money flowing to encourage people not only to borrow to continue to pay for the mortgages, but to buy the supplies to build those homes and get that economy to grow its way out. So what that's going to do, in our opinion, is push that supply out to us, lowering the prices, which would then be beneficial to the U.S. consumer. What we're trying to get away from is that insatiable demand, and I would submit you're seeing that slow down already. How many vacations can people take? How many new wardrobes can people buy? That's the argument you have. The proof point really will be this upcoming quarter, because even through the height of energy prices skyrocketing throughout the second quarter and through the summer, even with airline tickets going through the roof, rental cars going through the roof, people had booked those trips forever, and emotionally, as we all agreed, we wanted to see our family, we wanted to travel. With kids going back to school as we speak, business travel not returning to the same degree, we're going to see demand start to slow in that area as well. And so as supply increases and demand slows, you're going to have that equilibrium come through with the stimulation of the economy that needs it. And I would argue that the breaks here in the U.S. that we do need to get those demand-supply characteristics back in line.
With that, I think we're going to wrap it up.
Perfect.
Todd Barney, thank you so much.
Thank you, my friend.
TB, as I affectionately call him, that was fantastic. Thank you very much.
Thank you.